So welcome to the session of Data Science for Non-Life Insurance. Today we're going to talk about claims reserving. So that's something new. It's another kind of job compared to the pricing examples that we've been discussing so far. So let's see what this is about, right? Here is the outline for today. So in the first, let's say, 4 blocks, I'm going to discuss about the basic principles. So why do we do claims reserving? What kind of terms or what is there to know about the foundations? And then we'll dive into a very classic technique to calculate or to estimate claims reserves. That's the chain ladder technique. I will first present that as a purely deterministic algorithm. And I will then step from the deterministic version of chain ladder to a stochastic version with these terms or these approaches that you see over here with Mack's contribution, with the use of a generalized linear model. And then finally, we're going to discuss about the use, we're going to talk about the use of the bootstrap in order to come up with a predictive distribution of the claims reserve, right? So in terms of purely the techniques or the working principles of algorithms, there's nothing new here, and we can understand all of these different techniques, like a GLM, like a bootstrap, like working with an estimation error and a process error. But the new thing here is the way how we put things together and the kind of problem that we have in mind to be solved. In terms of literature, I'm not exactly following a book here, but I put together some sheets based on a couple of references. So here you find a reference to the book of Mario Wüttrich on claims reserving. This is the Wiley edition, but there is also a freely accessible edition available on SSRN. So that gives you a whole manual on claims reserving techniques. So here is a reference to the one on SSRN. And you can also find chapters on claims reserving, for instance, in this book by Arthur Charpentier and colleagues. So there are a lot of resources out there. I put together the essential stuff that I want to cover here. Good. So let us start with the motivation. So we're going to look at the dynamics in an insurance claim. So what we want to do here is we want to look at the history of a typical non-life insurance claim. And I'm going to identify the following interesting events that can happen during the lifetime of such a claim. So when we sold a policy to a policyholder, to a client, then of course, as an insurance company, we make a promise, or we're liable to cover the financial costs that my policyholder potentially will encounter related to the insured events in my policy. So we're now going to look at what's happening after we sold this policy to our policyholder, and what's going to happen in case of the occurrence of such an insured event, right? And we're going to look at the timeline that runs from there on. So the starting point here in my timeline is the occurrence of an event that is covered in my insurance contract. Think of an accident, think of a claim, a motor accident, an accident at work, something like this. So this is the occurrence of my event. Then after this event occurred, my policyholder will report this event to me as an insurance company. So I also identify here on my timeline the reporting of this event. Now, of course, this reporting can take place on the same day as the accident. It can happen one day later. It could also happen several months or several years later, in case the damage that occurred is not immediately noticeable. So we call this delay between the occurrence of the event and the reporting of the event, we call it the reporting delay. Now, after the claim has been reported to the insurance company, and if the insurance company accepts to compensate for the financial loss that happens due to this event that occurred, then a few loss payments will follow. This can be a single payment, this can be multiple payments with a certain time in between. These are the payments that the insurance company makes to the policyholder to compensate for her loss. And this timeline goes on until the settlement of the claim. So the settlement or the closing of the claim, the loss has been covered, the claim can be closed in our books. And we call this delay between the reporting of the event and the settlement of the claim, we call that the settlement delay. Now, of course, what may happen in reality is that a certain claim has to be reopened. That could happen. It's not indicated here on the timeline, so I'm not gonna, what I'm gonna assume here that this reopening would then happen before the final settlement, let's say, of this claim. Now, these two delays, these are important because that's what it's all about. Because there are such delays, we will be forced as an insurance company to keep a certain amount of money called the technical provision, the claims reserve, in order to be able to settle our liabilities towards our clients in the future. Yeah, so the events happening and being reported with some delay, that's in fact relevant in many disciplines, not only insurance, also in epidemiology, also in liability claims, in manufacturing applications, and so on and so forth. You will find there some literature on that as well. Now, what we're going to do is the insurance company is unable to settle this claim immediately. And that's because of the reasons that we just mentioned. There is the reporting delay, there is the settlement delay, and closed claims may need to be reopened due to some new developments coming up, right? And we're going to distinguish now between a couple of different types of claims. And the first claim that we're going to distinguish, that's a closed claim. So when is a claim closed in our books? Well, then we have to put a certain present moment or a moment of evaluation. That's the moment that we're going to calculate our reserves, right? So that's my present moment. And a claim is closed if the claim happened in the past, so before the present moment, and it's also actually settled in the past. Yeah, so this whole timeline that I have here is happening before the present moment. So this is a closed claim. This is a claim for which I do not have to book in principle a reserve, unless of course I would keep the option open that with a certain probability, certain claims will reopen in the future. This is a closed claim. A next type of claim that I want to distinguish is a so-called RBNS claim. So RBNS is a well-known acronym in the insurance literature that stands for a reported but not settled claim. So in my setting, that would mean that the reporting of the claim is happening before the present moment, but the closing of the claim is going to happen in the future. So there is some uncertainty from the present moment on about how many extra payments will follow in the future, when will my claim settle in the future. That's unknown, so I need a statistical model, I need a predictive model in order to make an estimate or in order to generate some scenarios about what's going to happen in the future. So keep this acronym in mind, RBNS, reported but not settled. And then next to this, we also have this other type of claims that has to do, and this type of claim has to do with the presence of this reporting delay. So here I have a so-called IBNR claim. That's an incurred claim, which has not been reported yet. So that means the event that is covered by my insurance contract happened in the past, but the insurance company is not aware of this accident yet. So the reporting of this event will happen in the future. So here, if I'm working with my IBNR claims, with my IBNR events, then I try to make a prediction about how many claims will pop up in the future, but actually happened already in the past. Yeah, and then of course I will also try to make a prediction for the cost that such claims will bring for me as an insurance company. So these IBNR claims, these IBNR events, that has to do with the reporting with delay presence. All right. So why do we need to book reserves? And you already discussed this to a certain extent in the course of life insurance, because there you would call it policy valuation. So that means you would also hold capital in order to make sure that you can fulfill your liabilities in the future with respect to contracts that you sold in the past. That's the whole idea. Yeah? So why do we reserve? Well, first of all, something we need to mention, our production cycle is inverted. So that means that the premium income precedes the cost. So we already discussed up to now a lot of different predictive models in order to come up with a prediction of frequency severity such that we can come up with a prediction of the risk premium of such a contract. And we need to do that because we cannot observe the cost on our contract beforehand. In such a way that we need these predictive techniques to come up with a price of our insurance cover. Now, the total cost on a contract can only be evaluated a posteriori. It can only be evaluated after the closure of my claims, of all contracts, the complete payment of all claims. So, and of course, like I already said, the premiums are paid before the beginning of each contract. So what is important for a regulator, from a regulator perspective, or what's important in terms of guaranteeing the solvability of our insurance company, we need to hold capital at any point tau, let's say, we need to hold capital, which should be sufficient to be able to cover in the future our liabilities towards contracts that we sold in the past. So it's about that idea. It's the estimation of this amount of capital that we need that the claims reserving actuary or the claims reserving methodology will allow us to do. So at any point tau, present time evaluation moment, we will predict the outstanding loss liabilities or cash flows. And we call this the claims reserves for past exposures. So what do I mean with the past exposures? These are the contracts that I sold in the past. These are the promises I made in the past about what I would do as an insurance company in case this event that comes with a certain financial loss would happen to my clients. Then I made the promise that I would cover, that I would compensate them for their financial loss. So I need to hold this reserve for past exposures such that I'm able to fulfill my promise in the future. So this is very important. It's all about accidents that happened before time point tau. And we're not predicting here any accidents that will happen in the future. That's a different job to do, right? Here we're looking backwards, and we're looking at what kind of euro amount do I expect to be paid on accidents that happened in the past and euros that I will have to pay in the future. So the need for claims reserve on the one hand, and then the difference between an IBNR and an RBNS claim on the other hand. That's important so far. So let's now look at the kind of data that we have available in order to work with this type of models and this type of calculations. So here what you see is the detailed timeline, if you want, on an individual claim, as I already discussed it on the previous sheets. Now, what an insurer will often do is they will aggregate the data from such a timeline. They will aggregate the data, compress the data in a sort of two-dimensional display called a runoff triangle, and they will do their calculations at a certain portfolio level, let's say, at a data set that is an aggregated data set. And I'm going to explain the structure of such a runoff triangle right away on the next sheets. But this idea is important. You take the granular data at the level of an individual claim, and you're going to do an aggregation step, put all these data together in a runoff triangle, and use the runoff triangle to build your reserving model on. That's the typical setting. So we go from these granular data to aggregated data. Now, this whole aggregation operation, it's sort of questioned in part of the literature on this topic, including my own work. So many authors, many researchers also say, okay, why don't we build our reserving models directly at these, based on these granular data? Because that's also what you would do in a life insurance context. There you would also calculate the policy values at the level of an individual contract. So here you see that historically, the techniques for claims reserving, which have become state-of-the-art and mainstream, they are designed for these run-off triangles. But nowadays, and especially with the upswing of predictive modeling techniques and the way how we can more easily handle large data sets, people are also looking into what if I design models directly at the level of these individual claims. And you can do that in continuous time, you can do that in discrete time. There are lots of different options there, and that's what is currently being explored in the literature, let's say. So here is an example of such a run-off triangle, or a claims triangle, a claims development triangle, or a run-off triangle. So this is important for us to understand. So how is this aggregation put together? So you have the following dimensions in such a triangle. You've got the accident years here, and you've got the payment delays, or development years, if you want. You've got those in the columns of your display. And here you find certain numbers, and be aware that each number that you see over here is like a sum of underlying data coming from the development of individual claims. So what does it mean? I'm gonna look, for instance, at the first row in my triangle. These were all these were all claims related to accidents which happened in the year 2004. And if I look at the number here that comes in the first column, this is what I paid for those accidents with 0 years of delay. So that means payments that we did in the year 2004 itself for accidents that happened in the year 2004. And if we move to the second column, this is what we paid in the year 2005 for the accidents that happened in the year 2004, and so on, right? So you'll see here, if I look to the most recent accident year in this example, that's the year 2013, then I've got one number here, that's what I paid in the year 2013 for accidents that happened in that same year. Of course, if I move to the next column, that would be the future then. So that's what I would pay in the next year for accidents that happened in the year 2013, right? So thing that you may have noticed already is that then all these numbers which are on the same diagonal, for instance, this diagonal, these are all payments that we make in the same calendar year or the same accounting year. For example, the most recent diagonal here, these are all payments done in the year 2013. What is our job to do? The job is to make a prediction for the lower triangle. So for all the cells which are empty here in my display, that would be those would be cells referring to the future, the year 2014, 15, 16, 17, and so on. And I want to predict, what do I expect to pay in those future years for past exposures, right? Because we're still looking here at claims that happened in the past, in the year 2004 to 2013. Yeah, so that's the kind of information that we put in such a triangle. And I hope you all realize that if you pick a cell from this triangle, that it is indeed a sum of detailed underlying payments that come from the cash flow of individual claims which happened in a particular year and which were paid, for which the compensation was then paid in a certain development year. Yeah? So that's the idea. That's what people have been doing. Now, of course, it's not a surprise that people have been processing the information in such a way, because they go then from detailed data at granular level to a display that they can easily handle in a tool like Excel, in a spreadsheet, in a report for management, for the regulator, and so on. So one of the main advantages of doing this aggregation is that you keep the data, let's say, small, to a small size, and that you have a tool that you can quickly use for reporting and for explaining evolutions in this cash flow, let's say. Right? So that's important here. Now, if I play a bit around with this display, then you should see something happening. So what is happening here? If I go from the display that we just discussed to the new one. So if I jump from here to there, what I'm doing is I'm going to aggregate now also in the horizontal direction. Yeah? So we call this triangle, we call it a cumulative view. So if I look now at a cell in a specific row, then the number that I find there is the amount of money that I paid up to this development year for all the claims that happened in a specific accident year. Yeah, so that's my cumulative view where I say, okay, this is what I paid so far for all the claims that happened in a specific accident year. We call the previous display, we call that a incremental triangle, because here I'm really looking at what is the amount that I paid in a specific development year for claims that happened in a given accident. So what we're going to do now is we're going to introduce some more mathematical notation for these kind of triangles for the problem that we're looking at, such that we have some stochastic variables available, etc., that we can build models for. So here we go. We're going to use I for the accident year, the year of occurrence, and I'm going to let the I run from 1 to capital I, the most recent accident year in my data set. I'm going to use J for the development year, and I'll let J start from 0, and I'll let it run till capital J, right? Xij is my notation for the incremental paid amount in development year J for claims happening in accident year I. So I could also say then this Xij is paid in accounting or calendar year I plus J. And then for the cumulative claims, I denote them with Cij, and with the Cij I make a sum of those incremental claims. And I keep the I index fixed, so I stay on the same row, but I'm gonna sum over the columns in this row. So it's a cumulative sum that I'm taking, and I'm gonna denote it with Cij. Then of course, if you look at the ultimate claim amount for a specific accident year I, that would be the Ci capital J. So that's the amount that you would ultimately pay for this particular accident year on all the claims that happened in this accident year. Okay. Now what we get then is, if I display the same triangle in a more mathematical point of view or mathematical notation, I get something like this. So what we often do, but it's not really necessary, but often we say that we have the same number of accident years and the same number of development years. So in that case, the J that I have here as my final development year would be equal to I, my final accident year, minus 1. That doesn't have to be the case, but yeah, it's often convenient for the examples or the displays that we construct over here, that we're going to assume that the number of accident years is equal to the number of development years. Then everything above this diagonal that I indicate here are my observations, which I can denote with a calligraphic D. So these are the data, these are the observations made in the past. And the job now is to predict the cells in the lower triangle, which I will denote with calligraphic DC. So that would be the complement of the data that I observed. That will be what I will observe in the future. Now, the fact that this is a bit irregular, the stairs that I plotted over here, that just has to do with my limited LaTeX knowledge. So there is no further meaning to be attached to that. So I just wanted to indicate here that there is this, this boundary, let's say, that denotes the present moment, and that splits or that separates the data we observed in the past from the cells we need to predict in the future. So this is important. This is my notation. You can also then mathematically indicate, if you take a combination of a cell I and a cell J, which condition needs to be fulfilled in order to have this cell being observed in the past, or in order to have this cell in the future. Well, in my notation, this would be that I plus J. If it's smaller than or equal to capital I, then this would be a cell observed in the past. So for instance, take accident year 1, development year 0, 1 plus 0, that's 1, that's below the most recent accident year, and so on. Yeah. Now, what can we put in such a triangle? So far, we've been talking about euros, but we could also put other things in this triangle. So let us first think about the incremental view, denoted with X. Then you can think about claims payment, so euro amounts that you actually did in cell IJ. That would be the example we discussed so far. You could also look at the number of reported claims reported with a certain delay. So in that case, you would put numbers in the table, and these numbers would refer to how many claims happened, how many accidents happened in a certain accident year I, and were reported in development year J. And of course, if you put that kind of information in your triangle, and you apply one of the models that we will discuss for triangles to such a triangle, then you're going to make predictions about the number of IBNR claims, the number of events that you would happen to, that you would expect to pop up in the future, right? So that's an interesting kind of triangle to be used often. This is again related to all these different fields where the occurrence of events reported with delay can be relevant, because then of course also this kind of techniques that we will discuss in the class can be relevant in order to come up with such predictions for the number of events we think will be reported in the future. All right, so we were here about these incremental claims. Number of reported claims, that's another ingredient that you can put in the triangle. There's a last one as well that has to do with incurred amounts. Now, I'm briefly going to explain that here, but I'm not going to assume that you are aware of this for the exam or something. But an incurred amount, and this in fact has to do with the large claims that Kevin was talking about. The incurred amount for an insurer, what that is it is what you actually paid so far, plus a case estimate determined by the claims handlers in the insurance company, a case estimate of what you will expect to pay in the future. So this case estimate is then often not necessarily determined by an algorithm or by a predictive model, but it can also be like an opinion or an expert vision that a claims handler has on what is going to happen to this specific claim, given the circumstances and given the detailed information that the claim handler has about what happened. And this is, for instance, used by reinsurance companies because, of course, they only get claims above a certain threshold. So they only get the very large claims. And then they work with these incurred amounts very often, because these claims take so much time to develop, and because they're quite big, quite substantial. It takes a while before they exceed the threshold. And then they often use these incurred amounts just to get a better grip, even if it's based on expert opinion, a better grip on what is expected to happen on such a claim. Yeah? So you can work with actually paid euros in an incremental way or a cumulative way, or you can work with incurred amounts. And then these incurred amounts are actually paid euros plus a case estimate on top. And this case estimate is what my experts, my claim handlers think what we need, the amount of money that we need to settle this claim. And if you then want to use these incurred amounts in an incremental way, then you're going to look at changes in incurred claims amount. Because if you look here at the other side of my display, if you look at the cumulative numbers, you can either put in the triangle cumulative payments, you can put total number of reported claims, or you can put in there the reported incurred losses. So that's what is typically used if you want to work with this incurred data, with these incurred amounts. Then we typically do that in a cumulative way. Yeah. But if you then make the difference from between two cells, you'll get the change in the incurred amount. Now, of course, sometimes you've got other sources of information as well. You may have covariates, right? Because you may have some information about what actually happened, what kind of accident. Was it a bodily injury claim? Is it a material damage claim? And so on. You may also have some external information. What's happening to inflation? Was there a change in the law? A state of the economy change? Something we need to keep in mind. So these are typically other types of information which are typically ignored if you work with such a triangular display. So most of our claims reserving methods, the state-of-the-art ones, are rather based on a single source of information, a single triangle that captures the whole thing. So the fact that we ignore this information, that's also one of the reasons, motivations, why people are currently experimenting a lot or exploring a lot what they can do with the detailed data at the level of the development of an individual claim. And using predictive modeling techniques, machine learning techniques, as we've discussed them so far, because that would allow us also to use these kind of covariates, for instance, about was this an accident caused by an animal or an accident caused by a kid or something in a liability portfolio, and maybe we can use this type of information to get a better grip on our estimates for the outstanding amount of the claims. Yeah, but for today, and since this is still a bit more in the research kind of stage, I'm going to focus on the state-of-the-art techniques, and I'm going to focus on discussing methods which are designed for runoff triangles. Yeah, but if you look at the research we're doing in the group, especially the research of Jonas, if you look at some master theses which are written every year, then you'll see that to a certain extent, and we also explore what can we do with this more detailed information. So what is our goal? We want to predict the ultimate claim amount. The ultimate claim amount on a specific accident year I. So here I refer to capital I minus 1, because that would be, in my notation, the final development year, if I assume that I have the same number of accident years and the same number of development years. So I want to predict for a particular accident year the final claim amount. The final claim amount, or the total number of reported claims. And if I rewrite this to an actual reserve, a reserve for accident year I, then I can see this reserve as either a sum of incremental cells, XIL, or I can see this as a difference between two cumulative numbers, right? So this is something important, and it's a lot of juggling around with the indices, etc. But if you say, what is the outstanding amount in the incremental point of view, then it's the sum of the cells on this row, the sum of the cells that refer to the future, right? So that's what I do here. I have XIL, and I let the L run from I minus E plus 1 to I minus 1. So these are these cells that come in the future. But if you say, okay, what's the outstanding amount for an accident year I? If I think in the cumulative display, then I look at the final cell in my cumulative display, and I subtract from it the most recent cell that I observed in my cumulative display. So that would be the last cell that I observed on this particular row, on this particular accident year I. the most recent cell, the last cell that I observed in my triangle display. Yeah, so that's my job, either give a prediction for this guys or deliver a prediction for this guys. And so do aware that this number here, that's a cell on the most recently observed diagonal. So this is a known, right? So here the only unknown is this guy, the final cumulative amount on a particular row. So that's my goal. And maybe this is a good time to take a break. Any questions on this? That makes sense. So far we only motivated the problem, introduced some notation and so on. And so in the next hour, we're going to dive a bit more into what kind of techniques do we have available in order to come up with these predictions and the corresponding uncertainty. All right, so before we dive into the algorithms, a few extra words. I'm going to quickly go over the next sheets. But they are important, especially in the context of Solvency II, because of course the story that we built so far is we're going to predict the triangle or the remainder of the triangle, the lower part of the triangle, at, let's say, at time capital I, which is the most recent accident year, the most recent year of information we have available. And we're going to use for that the information we have so far. So in mathematics, we often denote that with a filtration, capital F here. But of course, we can also let this filtration move over time. So we can also say, yeah, what if I have an additional diagonal of information available? Then I can do the calculations again. I can predict my outstanding amount again, and so on and so forth. So that's a bit of notation that we can introduce for this. And the whole idea is that what we're going to try to predict, if we talk about a best estimate reserve, what we're going to try to predict is the expected value of a cell in the lower triangle. Yeah. And if here I write that down in a more general way, so here I let the evaluation time run over time as well. So I let this small t run from 0 to later values. And if I start with t equal to 0, then we have the exercise as we introduced it so far. And then we say we have all information up to and including accident year I, and we want to make a prediction for the future. And what we then refer to as our best estimate is the expected value of the cells in the lower triangle. But of course, if we have an extra year of information, then we can do the exercise again, and so on and so forth. Yeah, that's what this notation is about. So these best estimate reserves, they are a predictor for the underlying random variables, of course. We call them nominal here because, like Kevin already introduced, they don't take any time value of money into account. But this is often what we refer to as our best estimate. Right? And we go for an estimate of the expected amount, the expected value of these random variables that represent our cells in the future of our runoff triangle. I'm going to skip that here. We'll come to that later on. So two next tasks. Once you have this prediction for the outstanding amount, the expected outstanding amount, and two next tasks that one can do is to make an adjustment for the time value of money, like Kevin introduced, and then we come to our discounted best estimate reserves. So the kind of discounting factor or curve that you can use, the fact whether you're allowed to do the discounting or not, as I mentioned, that depends on the accounting and regulatory framework that you're using. Because of course, the whole idea of claims reserving is that you're going to report about these reserves to a regulator, or you keep this value of the reserve. You keep that in your balance sheet. I forgot to mention that, but it's a very important item, of course, on the liability side in your balance sheet as an insurance company. Yeah. So this is what we do it for, to be able to fulfill our promises in the future, and to know, okay, we're still liable for this particular amount of money. So doing this discounting, I'm not gonna cover it in the sheets, but be aware that if you do this for a solvency, if you do this for an IFRS context, then there will be some guidelines there about how to discount your best estimates. And then the second thing is we started with looking at the expected value of the outstanding amount. We should also add a risk margin to that because, of course, we have the risk here of under-reserving, right? Of not having enough capital to be able to fulfill our liabilities. So what we're going to do is we're going to add a risk margin because there's downside risk in our outstanding loss liability predictions. And then the whole combined discounted and risk-adjusted reserves, that is what we would call our technical provisions in a Solvency II context. Yeah. So that would be the next step, which I don't cover in the sheets, but having the information in the sheets, then looking also at these next steps should be a rather small step. And you should be able then to get some grip on how to do that. All right. So here are our goals. We want to get this best estimate, and we want to also quantify the corresponding uncertainty, or even go beyond that and get a full predictive distribution of the outstanding loss liabilities. So traditional focus in this literature and with the use of these methods in practice has been on the long term or the ultimate view. So what we mean with that is that we want to predict like the ultimate claim amount, so the last column in our cumulative triangle, or we want to predict all the cells in the lower triangle, right? But nowadays, if you look at this exercise of reserving in a Solvency II context, for instance, then besides this ultimate view, also the short-term view is important. And what I mean with the short-term view is that we ask ourselves, yeah, how do our reserve predictions change if we have a new diagonal of information available? So that's one of the things we're also gonna evaluate in a Solvency II context. That's called then the claims development result. So then we're gonna simulate a new diagonal, the next diagonal, and we're gonna see if we have this simulated extra diagonal available, how do our predictions for the outstanding loss amount, how do they then change? And we call that the claims development result. And it's this claims development result in combination with the cost of capital reasoning that we're going to use to determine our risk margin in a Solvency II context. Yeah? So that is, these are like the next steps that one can do using the techniques and using the concepts that I will introduce in the lecture. Yeah? So it's either about, it's about predicting the ultimate claim amount, but one of the questions you can also ask yourself is, yeah, if I would simulate, if I would generate an extra diagonal of information, how will then my predictions of the ultimate claim, how will they change? And that's what I call the claims development result in a Solvency II context. Now, if we look at some algorithms and some techniques to do all this kind of calculations, then what I would do is I would do the calculations or do the simulations in a tool like R or something like that. But I just want to mention here that there are multiple commercial tools also available. And you see a brief selection of some of them over here. So these are commercial packages which are purely dedicated to claims reserving, and which allow you to do the kind of calculations that I will mention today, also the Solvency II, the discounting, etc., etc. That will be available typically in tools like these. Yeah, so that's just for your background. If your company happens to use one of them for the claims reserving, then you know where that's in which light you should put this. All right. So let's do a first algorithm to come up with our best estimate predictions for our outstanding amount. And this first algorithm we're going to do, it's called the chain ladder. Yeah? So this is historically the most popular method to come up with your best estimate calculations. This is also underlying um, the technique in Solvency II. Somebody has to help me now. Not the internal model, but there is a name for the prescribed way to do it in Solvency II, and I cannot come up with the
standard formula.
The standard formula. Thank you. That's what I was looking for. So this is also underlying the standard formula approach in Solvency II. So this is an important one to keep in mind, this chain ladder. And I will start with explaining it from the purely deterministic, algorithmic kind of way. And then we're going to make stochastic assumptions around this chain ladder approach. So first of all, if you look at the chain ladder, you're going to start with a runoff triangle in cumulative display, right? So what you see here is our cumulative runoff triangle. And the first thing we're going to do is we're going to make an assumption. And this assumption is about how do cumulative amounts on the same accident year, how do they change over time? And we're going to assume that there is this relationship which I stipulate over here. So I get the amount in red, Cij plus 1, by multiplying the amount in blue, that's the cumulative amount in the preceding development year, by multiplying that with a certain factor called the chain ladder factor. And I'm going to call it here Fj, H2H factor, chain ladder factor, or the link ratio. Yeah. So this factor is gonna, if I multiply this cumulative amounts with the appropriate factors, then I'll get the chain ladder predictions for my outstanding amount. So how does that work? First of all, let us calculate the factor called F0, which shows me how to go in expected value from the numbers in the first development year to the numbers in the next development year. So how do I get this F0 in my chain ladder method? I'm going to sum the cells in red, and I'm going to divide them by the sum of the cells in blue. And mathematically, of course, I have to be aware of my indices and make sure it goes well, etc. But that's what I do. So you take the sum of the red guys, you divide it by the sum of the blue guys. So make sure for the blue guys, you're not using the amount over here, right, in black. And that gives you a development factor, in this case, of 1.49. So that shows me, in a kind of averaged way, how I go from the cumulative amount in development year 0 to the cumulative amount in development year 1. So if I need to make a prediction for the next cell here, right, in the last accident year, development year 1, then I'm going to use my factor and multiply it with the cumulative amount I observed so far. And that will give me a prediction in a purely deterministic way for the amount that is missing over here. So that's what I do. I get this 8,471 something by multiplying the cumulative amount here with my 1.49. That's what the chain ladder does. So we move on. We calculate the next development factor by taking the sum of the red guys, dividing it by the sum of the blue guys. I'll get a factor over here, which now shows me how, on average, I go from the cumulative amount in development year 1 to the cumulative amount in development year 2. Having this factor, I do my multiplication thing, and I multiply either the most recently observed amount in development year 1 with my development factor to go to the next cell, or I use the estimate that I already have over here, multiply it again with my development factor, and I get my prediction over here. So that's what's written here in math notation. I move on, and as you will expect, if I look at the last development year factor that I need to calculate, I'm only facing 2 cells here, right? So I just take their ratio, I find the development factor approximately equal to 1 over here, and I will use this final development factor in order to complete my estimates for the final claim amounts in this last column. So this is what I get if I complete the whole triangle. And what I display here at the bottom are the development factors that my chain ladder calculated for me. So what I do here, it's what I call a purely deterministic view. So I didn't mention any estimation or any model assumptions, any assumptions about a variance or an expected value or a distribution or whatsoever. I didn't make any of such assumptions. This is purely deterministic algorithmic kind of calculation, which is really historically still the most widely used principle in practice to do this kind of evaluations. So this is what we get. How do I connect the reserve to that? Of course, these are cumulative amounts. So if you want to know, for instance, what the reserve is corresponding to the final accident year, then you need to make the difference between the ultimate claim amount and the claim amount observed so far. So the difference between these numbers is going to give you the outstanding amount, at least in what you expect to happen for this outstanding amount. That's what I did over here. This is a nice wrap up then of these chain ladder type of calculations. So what do we list here? Maybe that's a good question for you. So if I would ask you for each of the columns here, what is displayed? So what do we have over here? This is the CI and then capital I minus I. So that's the cumulative amount on the most recent diagonal. So these are the cells that I get over here. So I observe these cells. These are the cumulative amounts that my chain ladder is going to start from, because I'm going to multiply these amounts with certain factors, right? So that's what's displayed over here per accident year, ranging from 1 to 10. If I then look at the column over here, this is ultimately what my chain ladder would predict or estimate, right? So these are the numbers that correspond to the final column over here, okay? And then if I make the difference between this cell and what I observed so far, I get the outstanding reserve amount, right? And what is then this ratio over here, the development to date? So that would be the ratio between what I observed so far and what I expect to be paid in the end. So the ratio between these two numbers, that's the development fraction or something that I observed up to now. So here my ultimate claim amount over the whole portfolio that is captured by this triangle would be about 6 million euros in a best estimate nominal way. So no discounting applied, no risk margin, no whatsoever. Okay, so that's what my chain ladder does. I can do this with the chain ladder package in R. I can share this code with you afterwards. But this is like a built-in visual then of such a triangle. So this is obviously a cumulative triangle where each accident year is represented by a single line. And for instance, here you see the line indicated with the ones. So these are the numbers for accident year 1 over the different development periods. And you see it's kind of a growth curve because you display these numbers, of course, in a cumulative way. If you look at other displays made by the chain ladder package, so let's say a few words about these. So this is the cumulative pattern that we already explained on the previous sheet. But of course, here it is completed with our best estimate calculations as obtained with the chain ladder. So here, each growth curve moves on until the final development year. So I start with my observed data and I project them further along the recipe provided by the chain ladder, okay? And here you see something similar. So here you have the cumulative amount displayed in black. And on top of that, you get the outstanding reserve as calculated by the chain ladder. We do see that we put an error bar on top of this. This is something we didn't explain yet, but that will be the next step in our in today's lecture. So how to come up with a measure of the uncertainty that comes with the prediction delivered by the chain ladder. So that's what the method of Mack stipulates. So that's what I will explain next. Now, of course, I can also calculate residuals using the predictions that I make for each of the cells in my triangle. So residuals, I can only calculate them for the observed cells, right? Because for a residual, to be able to calculate the residual, you will use the actual observation and then the prediction of the chain ladder. So how do you think we can come up with a kind of estimate for the cells in the upper triangle using the chain ladder reasoning? So that's a question for you. Maybe it's a bit unclear, but I want to calculate residuals, and I want to calculate them for the cells in the upper triangle. So how would you do that using the reasoning of the standard chain ladder? Take the cells in the upper triangle and you apply the development factors backwards. And that gives you an indication of what the chain ladder kind of reasoning would lead you to. And that also allows you then to calculate a certain residual. And these are the residuals that you find in the display that comes with the R package chain ladder, right? So you see that, of course, the further you go in your origin period or accident period, the less residuals you're able to calculate, because there you have few cells observed. Why do we why do we display such residual plots? Of course, to see whether there's any trend or any outlier or something that we can spot in these displays, to give us an indication, okay, is there something going on, some cells that we need to zoom in, or to some things we need to consider in more detail. Yes, very good. So that's what's happening here. These plots were produced by the R package chain ladder, which allow you to quickly do the kind of calculations as I explained them on the sheets. So at this stage, my chain ladder is a purely deterministic algorithm. There is no assumptions. What we get is a point estimate or a point estimator denoted as a random variable for our ultimate claims amount using the information as we have observed it so far. That's the DI, that's the run-off triangle that we observed at the end of accident year I. But the next question that comes is then, how reliable is that point estimator, and can we get a measure of uncertainty that comes with this point estimator? And that's exactly what the Mack method will allow us to do. So that requires us to make certain assumptions about the stochastics. And we'll take it step by step. So we're going to start with an assumption about the first and the second moment. And later on, we're also going to make an assumption about the whole the whole distribution of the cells that we're going to work with. Okay, any feedback on that? I've got a bit of literature over here because this chain ladder method, it's very popular. It has been studied since a long time in the literature. You also see that people have been giving different underlying stochastic models for the chain ladder. So you can see a few references over here, and I will touch upon a few of them in the next sheets. So then we'll take the next step, and I'm going to say a few words about the principles behind Mack's distribution-free chain ladder model. Yeah. So what Mack did is he proposed a kind of stochastic or some stochastics underlying the chain ladder model, but he did this in a distribution-free way. So that means we're not going to say your Poisson distributed or gamma or log normal or something, no such assumptions. We're only going to make an assumption about the first and the second moment of my random variables, right? So I want to give you the highlights of this kind of thinking, because again, like in the standard formula in Solvency II, the same kind of reasoning is used. So I think it's good if you have a bit of a background on this. So here are the model assumptions from Mack. So he assumes that there are these constants, the development factors we encountered already, but he does make assumptions as well about the variance of a certain random variable representing a cell in the triangle. So we have additional constants here, which will be used to say something about the variance. And I'm going to denote them here with sigma squared. So what he assumes is that theCij's are independent in I, so they are independent if you compare if you look at different accident years, but they do form a Markov process in the direction of the development year. Because there we said that Cij plus 1 is only relying on the past Cij values if we by this particular assumption. So the only thing I need to know to say something about the future is what is the most recent Cij value that I observed. And the link between Cij plus 1 and Cij on average is formed by this development factor Fj. Now with Mack there comes this additional assumption that says something about my variance. So here is where the additional constants, the sigma j squared, where they enter. So these are the basic assumptions in Mack's model. And what we'll see is that we can estimate now these development factors, we can estimate these variance parameters, and we're also able to say something about the mean squared of prediction that comes with my chain ladder prediction. So that's what this Mack framework will allow me to do. It will allow me to give an error bar on top of the point estimate that I'm able to calculate via my chain ladder method. So what he says is then, if I know the chain ladder factors, the Fj's, if I know the observations in the upper triangle, then this is going to be the expected value for my outstanding claim amount. And this is nothing new. This is the chain ladder recipe as we've been applying it so far. Yeah. And he says, well, I'm going to estimate my unknown chain ladder factors in the way how we did it so far. And that was the sum of the red guys divided by the sum of the blue guys. These are the development factors which are used in the algorithmic chain ladder strategy. And then if I have these estimates for my development factors, then ultimately my chain ladder predictor for a cell in the lower triangle will be constructed by multiplying the cumulative amount on the most recent diagonal with the appropriate development factors. Now, so that's nothing new. It's just a bit of a formalization of the kind of thinking that we've been explaining in our discussion on the chain ladder strategy. So where do the new things come in? Well, we have these variance parameters, and they are here to quantify some prediction error, to say something about the uncertainty that comes with the prediction delivered by the chain ladder kind of thinking. And we're going to explain how this, or what the essential thoughts are within this construction of a mean squared error of prediction in the Mack strategy. And the first observation that I'm going to make is, well, you can also look at individual development factors. So if you look at this individual development factor here, then you're looking in fact at the development factor, but just comparing two cells which are next to each other. So they are on the same accident year I, right? And you compare then how you go on accident year I from column J to column J plus 1. So you can also calculate these development factors at the level of two individual cells. Whereas the original chain ladder development factor took the sum of the red guys divided by the sum of the blue guys. So now I just take one blue guy and one red guy, and I take their ratio. That's what I mean here with the individual development factor. Then if I look at these individual development factors, then I can see that my chain ladder development factor is in fact a weighted average of the individual development factors. And the weights that I'm using are these CIJs, the cumulative paid amounts in development year J. Yeah, so that's an interesting observation, which is one of the starting points of Mack's reasoning. So we can see this chain ladder development factor as a weighted average, a CIJ weighted average of this individual development factors. All right. And you can see that immediately. If you replace the Fij by the ratio over here, then you get rid of the Cij and you're back immediately to the original specification of such a development factor. So we're going to use this reasoning and we're going to translate it into our variance assumption, because we're going to say, well, we're sort of thinking then in a kind of weighted least squares or weighted average kind of thinking. And we're going to make an assumption that the variance of these individual development factors is inversely proportional to the weight that we are using for this individual development factor. So we have this kind of stipulation, which then, if I bring out the Cij, because it's observed, right? If I bring that out of the variance, then that becomes a 1 over Cij squared. So if I bring it to the other side, then my variance assumption is the one that I started with in my original formulation of my Mack method, namely that there is a constant, sigma squared j, which gives me the following relation between the variance of the Cij plus 1 and my Cij as observed so far. Yeah? So that's where this thinking is coming from the idea, okay, you calculate when you're working with these chain ladder development factors, you're calculating a weighted average of individual development factors. So I can make a corresponding variance assumption that says the variance of such an individual development factor is inversely proportional to the weight that comes with this individual development factor. And that's a common assumption in a weighted least squares kind of thinking. So Mack says, okay, if I translate this assumption, then there must be like this constant sigma j squared such that this relation holds true, right? And how is he going to estimate these variance parameters? Well, since we're thinking here in a sort of weighted least squares reasoning, and we can use an estimator from that literature, an estimator that is called a weighted residual sum of squares, to estimate the variance parameter. So what you're going to do here is you're going to look at the square difference between the individual development factors and your chain ladder development factor, and you're going to apply this this weight that we introduced earlier on. So if you compare this to what you will find in the literature as the weighted residual sum of squares, yeah, then you'll get exactly then this weighted residual sum of squares will exactly lead you to this kind of estimator for the variance parameter. Yeah, so that's a bit an underlying motivation of what this Mack method proposes. And of course, now that we have this distribution-free version of the chain ladder model, and we can estimate the development factors, we can estimate the variance parameters on the other hand. So now we're ready to analyze prediction uncertainty, and prediction error. And what we're going to do is we're going to use the chain ladder predictor as we know it. So that's the most recent cumulative amount observed, multiplied with our estimates of our development factors. Yeah? So if I approach these guys as random variables, then I constructed an estimator for the best estimate of the ultimate claim amount, or I can see this as a predictor for the random variable that represents the ultimate claim amount, given the data as I observed them so far. Yeah? So we're going to work with this chain ladder predictor. And what we want to calculate then is the mean squared error of prediction that comes with this chain ladder predictor. And the mean squared error of prediction, we already encountered that earlier on. That's the expected value of the square difference between the random variable that I want to predict and the predictor that I'm going to use for this random variable. And here I do that in a conditional way. So I'm going to condition on the data that are available in my runoff triangle at the end of accident year I. So it's a conditional mean squared error of prediction. And Mack's contribution is then to quantify, to come up with an expression in order to be able to calculate this mean squared error of prediction for the chain ladder approach. Yeah? And that would give us then a measure of uncertainty that comes with this chain ladder predictions. Now, in order to get our hands to get some grip on this mean squared error of prediction, what we're going to do is, I explain it here a bit so you can look into that. But what we're going to do is the following reasoning. So first of all, on the previous sheet, I had the mean squared error of prediction at the level of the ultimate cumulative claim amount. And the first observation that I'm going to make is that this mean squared error of prediction should be the same as the mean squared error of prediction if I'm reasoning at the level of the outstanding reserve. So that's my RI. And what is the reason for that? Well, the reason for that is that the step to go from the ultimate cumulative claim amount to my outstanding reserve, the difference is, the difference between these two is the most recently observed claim amount, right? So that's the claim amount, the cumulative claim amount on the most recently observed diagonal. So the difference between these guys is just that I need to subtract here the same amount over here and over here. So that's, I mean, if I would write that down, then you immediately see that these terms cancel out and that the mean squared error of prediction at the level of the outstanding reserve should be the same as the mean squared error of prediction at the level of the cumulative claim amount. So I'm not sure if that's clear, but it's about, if you take this expression for the RI, then it's going to be this guy minus a constant, and here it's going to be this guy minus the same constant. So these two constants cancel out, and you will see that the mean squared error of predictions are the same, whether you write them in terms of the outstanding reserve or in terms of the ultimate claim amounts. And now we're going to apply this principle, namely that if you look at the expected value of x minus a squared, that you can see that then as the variance of x minus a, but that's the variance of x if a is a constant, plus this guy, right? So we want to apply this rule of thumb, let's say. And then my question to the students is always, which of those quantities here, the c hat or the Cij, which of these two quantities will I approach as the constant a in my derivation? So if you look at the expression for this mean squared error, then I'm going to say, I'm going to apply this rule of thumb. So I'm going to identify one of the two as the x and the other one as the constant a. And I'm going to write down this expression in order to be able to move on with this mean squared error of prediction. So who will play the role of the constant a in this framework? So the c hat is purely constructed from the data in the upper triangle. So given that you condition on the upper triangle, you know everything that is inside the c hat, because the c hat is using the ultimate claim amount, the most recently observed claim amount, and it's using development factors, but these development factors are also constructed from the cells in the upper triangle. So that's the reason why we do the conditioning here. So given the information in the upper triangle, we know what the c hat is. We know what our chain ladder predictor is. So that's what I'm going to approach here as the A. And like Jonathan said, yeah, okay, we know then the variance of the ultimate claim amount. So we do this little trick over here. We approach the C hat as our constant A, and we can write down the mean squared of prediction in the following way. And what is really important now is that you recognize two sources of uncertainty here. There's on the one hand the process variance, and there is on the other hand the parameter estimation variance, right? And this is something that in fact we encountered already a couple of times, because in the machine learning literature, how did we call this? Or what you recognize here is a sort of the variance bias trade-off that we already discussed earlier on, right? So here you see this as the process variance, so that's the variability and the assumption that we make about the variability of our distribution of our random variable, and this is the assumption that we made about this sigma squared j thing. And what we see here is what is the uncertainty that we bring in by estimating this quantity with the chain ladder type of estimator that we propose. So what is the uncertainty? What is the error that we introduced by estimating our parameters that we assumed? Yeah, so if we fill that in along the Mack reasoning, you'll get a quite complicated formula. So there's no means that we're gonna reproduce the derivation of this formula. Just know that you can do this by relying on the assumptions that Mack made. It turns out that you can do this kind of calculations. You can get a grip on this and get around it. Okay, and this combines these two sources of uncertainty. So there is the variance assumption on the one hand, and then there is the uncertainty introduced by estimating the parameters on the other. The expression that you see here is for a single accident year, ultimate claim amount. Of course, what we also want to know is what then, if you take the sum over all the accident years, and you want to know, and you want to get a grip on what is then the corresponding mean squared error of uncertainty, mean squared error of prediction, sorry. And of course, the difficult thing here is the covariances introduced by the parameter uncertainty, because they're these different predictors, or these different estimators. They introduce the same, they use the same development factors, they use the same parameters, so there will be a covariance term popping up from that perspective. You cannot just say that the mean squared error of prediction of the sum of the outstanding cumulative amount is reducing to the sum of the mean squared error of predictions. That's not true, and because your different predictors working on different accident years, they rely on the same parameters, so some covariance term will be introduced over here. Yeah, so this is outside the scope of what I expect you to learn for the exam, but just be aware that Mack proposed us in a distribution-free way. He made an assumption for the expected value, made an assumption for the variance of the ultimate claim amount, and he showed us how we can use, or how we can translate that into a mean squared error of prediction. And this mean squared error of prediction is capturing both the variability as well as the parameter estimation error. So it's a combination of a variance bias kind of thinking, as we already introduced it earlier on. So here you see the calculations from Mack for the triangle that we already encountered earlier on. So we recognize this column, we recognize this column, and this column. And that's what we already calculated with the chain ladder. And now we can also mention the corresponding square root of this mean squared error of prediction. And so this allows me to put this error bar on top of the prediction that my chain ladder brought me already, right? So that's the extra thing I get here. I get a measure of the uncertainty that comes with this prediction. So Mack's assumption is not deviating. It's giving me the same best estimate calculation as the algorithmic chain ladder did so far. He only extended the framework such that with under certain assumptions, he was able to come up with this corresponding standard, with this corresponding measure of uncertainty. Yeah, that's the new thing we get out of this. You can also decompose. It would require you to go a step further, but this is possible. You can decompose then into the process standard deviation and the parameter standard error. And so I show here how the decomposition works, just to give you a feeling about where in this case, where the biggest source of uncertainty is coming from. And that's, in this case, from the process standard deviation. If we picture then the growth curve, so this is still for the same triangle that we encountered earlier on, you see the cumulative amount over time, and you see that we complete our growth curve or our prediction until the most recent, or sorry, until the latest development year. And you also see that on top of that, with these dashed error, we now add Mack's standard error, just to give a certain confidence interval or prediction interval for the predictions developed by the chain ladder. And of course here, there's not much to see yet because there are not many cells to complete. There's not much uncertainty here yet. But if you look, for instance, at the most recent accident year, and then of course you see that the corresponding error bar is going to be more visible, because there, of course, for the most recent accident year, we only have one cell observed. So that is difficult then to make the predictions towards the final claim amount. Yeah, there is more uncertainty coming in there. Okay, so I guess that's what I wanted to assume. Sorry, what I wanted to explain. There's one last remark that I can give here, and I think it's quite insightful. So you see here the assumptions in the Mack model as we propose them, right? So you've got the Cij plus 1, which, given the trajectory or the path in accident year I until development year j, can be assumed in expected value to behave like this. And for the variance assumption, you've got this connection. Now, as I already mentioned, this really looks like what you would do in a weighted regression kind of context. Yeah. So what we can do is we can easily reproduce the estimates for the FJs, the estimates for the variance parameters. We can easily reproduce the numbers that we find with Mack by running a weighted linear regression model. And the weights that we would use would be the Cij minus 1. And what we would use for our response, y, is the Cij plus 1. What we would use for the x value is the Cij. And we would go through the origin, right? Because here you see that you only have a slope terms times the Cij, but there is no intercept calibrated. So if you repetitively run these weighted linear regressions, then you'll find the FJs, then you'll find the variance parameters as we know them, right? So here you can see how I did that. The code is not super good, I guess, but I'm going to use here, for instance, the observed values in a cumulative triangle. I'm going to use column 2 and use my accident years from 1 to 9 from this second development year. And I'm going to regress it on the observed values in the cumulative triangle in the first column, right? The first development year. I put the intercept to 0, so I do a plus 0. So to say to R, okay, I don't need an intercept. These are the weights that I give. And what I then find for my beta estimate is 1.49. That's exactly the first development factor as we calculated in Mack. And if you look at this residual standard error, it's 135.3. So if we go back to our estimates for the sigma j's, which were displayed over here, then it's exactly the number that we find over here. Yeah. So that's also a way to see these Mack assumptions. It's kind of, I mean, it's similar to running a weighted linear regression, as I explained it on the sheets. And that's also a way to get your estimates for the parameters over here. Okay, good. Any questions on that? I know it's not easy, and if you look at these papers, there's a big derivation there to come to the expression for the mean squared error of prediction. But I just want you to make what you need to be aware of is that he makes this assumption for the expected value and for the variance. It's distribution free. It allows you ultimately to come up with a measure of uncertainty that captures both the process error as well as the parameter estimation error. And there is this analogy with the ideas behind weighted linear regression. I think these are the main three takeaways that you should grasp from this explanation. Yeah, and no further details about how to actually come up with this mean squared error of prediction, for example. So I'm going to pick it up over here for the last couple of sheets, where we're going to talk about the use of generalized linear models in a claims reserving context. Okay, so these are models, these are tools that we've already encountered earlier on. So the question is now, how can we link these to the setup of a runoff triangle, and what would be then the value of using this type of techniques in the reserving context. So first of all, remember what we're going to use here in this generalized linear model setting is that we're going to work with the incremental data, the xij's, and we're going to assume, if we're building a generalized linear model, that the increments xij from different occurrence years I and from different development years j, that they are independent. And the reason we do that is, of course, because we're used to do in a generalized linear model, when we build up the likelihood, we take the products over the contributions of the individual observations, and we're assuming there that we have independent observations. That's how we put the likelihood together. So here we're going to work with these incremental data, not with cumulative data, because if we would work with cumulative data, then the assumption of independence would not make sense, right? Because they're growing over time. But with incremental data, we can make this assumption. We're going to use a density. We're going to use a density from the exponential family of distributions. So we're going to pick here either a normal, a gamma, a Poisson. I've got a few options on the next sheet. So we're going to work with the density for my incremental data from the exponential family. And we encountered the building blocks over here. We've got our mean, we've got our variance assumption with the dispersion parameter, with the variance function, and we've got a certain link function that is being used. So do note that we have this double index here, the ij, that's still to denote a particular cell from a runoff triangle. So that's similar to, yeah, that's just how we tabulate or how we label the data here in this runoff triangle context. So I got a question here, but in fact I already gave the answer. So do we typically apply these GLM techniques to the incremental or the cumulative runoff triangle? So we work here on the incremental data, because there it's more natural to make the assumption of independence. If you would work on the cumulative data, then the independence assumption would not make sense. And we rely on this independence assumption in order to be able to write down the likelihood of our GLM in an easy way. Yeah. Now, which kind of distributions do we often encounter in stochastic claims reserving? Of course, you have different options there and different things you could verify or you could try on your given triangles. But I'm just going to list a couple of the most common assumptions that are used in combination with runoff triangle information. So the first one is a classic Poisson assumption, where we have a mean mu And this mean mu can be written as the exponential of a linear predictor. So this would be a valid assumption, for instance, if you're modeling an incremental triangle with number of reported claims, because then you have count data, and these count data could be modeled potentially with a Poisson assumption. Now you can also go a bit beyond that, and you can generalize the Poisson assumption to a so-called over-dispersed Poisson assumption. And with this over-dispersed Poisson, you still have the expression or the same expression for the mean as you would have in the regular Poisson, but you're gonna do a little tweak on your variance assumption in the regular Poisson distribution, and you're gonna make sure that you also allow for over or under dispersion. And how does that work? Well, we can say that if x can be written as a dispersion parameter phi times z, and z follows a regular Poisson distribution with this as the mean, then we can construct this over-dispersed structure, because then what we will see is that the expected value of x will be phi times the expected value of z, but the expected value of z, that's mu divided by phi, so the expected value for x is still the mu, right? But if we look at the variance of x, then when the variance of x is phi squared times the variance of z. But the variance of z, because it's a regular Poisson distributed random variable, this variance of z is mu divided by phi. So the variance of x becomes phi times mu. And if this phi parameter is above 1, then we are introducing extra dispersion or over dispersion compared to the regular Poisson assumption. Yeah? So this is how you can put that together. And in fact, this turns out to be a very common assumption when you're working with runoff triangles on which you want to fit a GLM, even if your runoff triangle is displaying euro amounts. And the reason why this over-dispersed Poisson is so popular, I will cover that on the next sheet, because it's essentially because with this Poisson assumption, you're able to get the same estimates as you would obtain with the regular chain letter. Yeah? So we're going to come to that later on. But do take into account that the second bullet, this is really a popular assumption to be made. You can also work with a log normal, you could work with a gamma, you could try these distributional assumptions and see what is best, most appropriate for the data at hand. But once again, mostly we're going to rely on this assumption, and I will motivate that in one of the next sheets. So this is about the possible distributions. How about the specification of our linear predictor? So what can we do there? Well, a typical assumption to make in the linear predictor is a so-called chain ladder structure, and that would mean that you're going to calibrate one parameter, say alpha, for each accident year, and one parameter, say beta, for each development year. So you're going to approach the information about accident year and development year as factor variables, and you're going to say, I'm going to calibrate one parameter for each level that this factor variable can take. Of course, you could do the same thing by including an intercept. You have to be aware of if you do a factor variable and it has 10 levels, let's say, then typically we would only estimate 9 dummy variables, or we would code 9 dummy variables in order to capture this factor variable. So the same constraints apply over here. If you would do it in this sense, then for instance, you would get 10 alphas, but only 9 betas. Because if you would have 10 betas, then the model would be over-parameterized, right? But this is the idea. Estimate a parameter for each accident year and estimate a parameter for each development year. Of course, you can do more complicated things. And some of the commercial packages that we discussed earlier on, some of these packages do so. So if we say, if we look at this literature and if we look at the actuarial practice, then most attention goes to the following GLM. Namely, you assume that your incremental data follow an over-dispersed Poisson with a specification of, for the mean mu ij. where this mu ij can be structured like this. So you have a parameter for each accident year, you have a parameter for each development year, but you have to be aware and you should make sure that you do not have too many parameters. So if you have a parameter for each accident year, then one of your betas will be put to 0. If you would include here an intercept, then one of your alphas will be put to 0, one of your betas will be put to 0. But this is the idea, that we're going to work with this type of structure. We do this with an over-dispersed Poisson if the xij's represent euro amounts. Now, why do you think we would do that? So why would there be the necessity to go from the regular Poisson to the over-dispersed Poisson if the xij's are euro amounts? But I'm referring more to why do we step from the Poisson to the over-dispersed Poisson? And like Emmanuel said, indeed, the regular Poisson would force us to have the mean equal to the variance. Yeah, but if you would look at euro amounts, if you would look at the example with the incremental runoff triangle that we've seen earlier on, there typically you have a lot of over dispersion because your variance is going to exceed your mean value there substantially, right? So because we're in fact trying to use the Poisson data here, Poisson distribution here, for data which are by no means count data, they're euro data, right? Euro amount data. So that's why we leave the regular Poisson and go to the over-dispersed Poisson in order to try to accommodate to a certain extent this, this right-skewed data that we typically encounter if we're looking at severity data, in fact, at paid amounts, right? Because that's what we're actually using here. But then you could ask, yeah, why do you want to do this with the Poisson? Why don't you step to a gamma or a log normal or something? Well, we keep the Poisson because if we combine the Poisson or the over-dispersed Poisson with this specification for the mean, then it turns out that our chain ladder estimator, as we discussed it so far, and the maximum likelihood estimator that we retrieve in this Poisson model, they lead to exactly the same reserve estimate. Yeah, so that's for many people a good thing. Then they stick to the, let's say, to the comfort zone of this chain ladder results. But we have now an underlying distributional framework that we can work with. And we also have the machinery from maximum likelihood estimation that we could use to do our estimations, to assess uncertainties. This is a first advantage of using the GLM, because then you do not have to rely on this Mack type of calculations to come up with a measure of uncertainty. So now you can use the ideas from maximum likelihood estimation as we know them, and also have available in many software packages to assess uncertainties. And one of the ways how we can do that is by then setting up this bootstrap exercise, relying on this GLM framework, on this distributional assumption, to come up with a predictive distribution of our reserve. So that's a motivation to leave the distribution-free framework, to go to the GLM, because then you have maximum likelihood estimation techniques, you've got model selection techniques, variable selection techniques. You also have something like the bootstrap available to help you there to get a grip on these the results or the calculations that you obtain with your reserving methodology. So let's take a look at that. So let's see how to proceed with this GLM in order to come up with eventually a predictive distribution of the outstanding reserve. So what we're going to do is the following. We're going to estimate the parameters in our maximum, the parameters alpha I and beta j, using maximum likelihood estimation. We can do that. We can do a quasi-Poisson in R. We can specify the accident year. We can specify the occurrence, the development year as a factor variable. We can do the estimations. We can construct the fitted values for the upper and the lower triangle. How do we do that? by using the inverse link function, that's the exponential here, by using the appropriate parameter estimates, putting them together like this. So this would give you a point estimate for the fitted value in a specific cell in your triangle. And you just need to use the appropriate alpha, the appropriate beta. Now, having this fitted value, you can also construct a Pearson type of residual for your upper triangle. And we discussed these Pearson residuals earlier on when we talked about GLM. So that's the observed value in your cell, that's the Xij, minus the fitted value, that's the mu hat, divided by the square root of your variance function. So in this case, with the over-dispersed Poisson, that would be the square root of the mu hat. So these are my residuals that I can work with. And using these residuals, I can now estimate the dispersion parameter by taking the sum of the squared Pearson residuals, dividing by the degrees of freedom. And the degrees of freedom here, that's the number of observations minus the number of parameters that I'm estimating. So if you would look at typical values for this dispersion parameter, if you would evaluate this on a runoff triangle with euro amounts, you really get large values for this phi. So this is not slightly above 1 or something, this is really largely above 1. So you get substantial over dispersion in a typical runoff triangle with incremental euro amounts. Now, having this available, how can we set up a bootstrap procedure? That's my final thing I want to explain here. I'm going to use the bootstrap ideas to come up with a distribution of my outstanding loss, of my outstanding reserve. And if I have such a distribution, I can calculate, I can estimate any type of risk measure that I would like to evaluate, right? So that's the main advantage with Mack. We were only able to say something about a point estimate and a corresponding mean squared error of prediction. If we run the GLMs with maximum likelihood estimation, then we would also be able to say something about a point estimate corresponding standard errors. But if we now going to take a next step with this bootstrap procedure, we can really draw scenarios, we can really draw values for the outstanding amounts using the principles of the bootstrap. So that's going to be the last thing to discuss here. So this bootstrap is a technique to obtain an approximate predictive distribution. You can also do that in a Bayesian way, but it's going to be much harder. It's going to require you to do more calculations, and it's just going to be more complicated than what the bootstrap will be. I've got a timeline here taken from one of the older presentations. This is a presentation by Peter England, who was one of the, let's say, the inventors or the main authors of discussing the use of the bootstrap for claims reserving. So this is a timeline showing you that the ideas of using the bootstrap in this context go back many years and still are very relevant and very popular to be used here. So I want to show you how that goes. Now about this bootstrap, I'm going to explain it here, but I also uploaded a separate video, well, 2 videos in fact, but one is a very recent video that I made with the app on my iPad where I explain the idea of the bootstrap once again. So even if it goes a bit too fast now, I kindly invite you to have a look at the additional video on Toledo. So here's what we're going to do. We're going to start with an over-dispersed Poisson model. So we're going to assume that the variance of Xij is phi times mu ij. We're going to calculate our Pearson residuals for all the cells in the upper triangle. We can do that because we have the Xij's in the upper triangle. We can estimate the mu ij's from our GLM for the upper and the lower triangle, and we can use the definition of the Pearson residual to calculate the Pearson residual in this context. Why are we going to rely on these Pearson residuals? Because that's going to be the working horse for us to set up this bootstrap, because we're going to resample with replacement from these Pearson residuals. And having the Pearson residuals, we can also go back easily to a corresponding incremental claim amount, because this relation here, it's easy to invert. If I give you the residual and if I give you the mu, you can give me the corresponding incremental claim amount. So the whole idea will be about reshuffling these Pearson residuals over here. If we have our GLM model, so if we start from the over-dispersed Poisson model, if we start with the specification for the mu ij as we introduced it, if we calculated the Pearson residuals, then we also get the Pearson, we can get our estimate for the dispersion parameter by taking the sum of the squared Pearson residuals dividing by the degrees of freedom. That's something we know from the theory of GLMs. Now, when I talk about the residuals here in the context of the bootstrap, what you will see in the literature then is that people often use not the Pearson residuals as we know them, but a slightly adjusted version for them. And we adjust the residuals for bias in the same way as we do with the scale or with the dispersion parameter. And the way how I always remember that for myself is that if you look at this definition of the dispersion parameter estimator, we're dividing here by the number of observations minus the number of parameters in order to make sure that we've got an unbiased estimator. That's the same as with your with a variance estimator, for instance. If you divide by n, then this estimator is biased, but if you divide by n minus 1, then the estimator is unbiased. So that's a similar kind of thinking over here that we apply, right? But you could also say, well, instead of dividing by n minus p, I can still divide by n, but make the adjustment in the residuals that I'm using. And that's written down over here. So if you would use in your estimate for the dispersion parameter, if you divide by n, but you would use adjusted Pearson residuals, R prime, in such a way that these R primes are defined like this, well, if you plug in this expression, then you see that you get exactly the same estimator as we initially had. But you obtain the estimator now by working with a division by n and by using adjusted Pearson residuals instead of the original Pearson residuals. So somehow we could say that these RP primes are Pearson residuals which have been adjusted for bias. And that's what many authors prefer to use when they set up the bootstrap for the runoff triangle exercise as we are going to do it, right? So whenever I talk about adjusted residuals, I mean that the following correction has been applied. And the reason why we do that is if you take these RP primes, you square them, you sum them, you divide them by the number of residuals that you have, then you get the same unbiased estimator for your over dispersion parameter as you would obtain if you would use the original Pearson residuals, but if you would then divide by n minus the number of parameters estimated. So that's a little trick that's often being applied here. So now we're going to go through these different steps of the bootstrap, and I picture them over here, and I'm going to explain them step by step now. So, but be aware, I've got this extra video where I explain all the ingredients from the bootstrap once again, where I also explain this bias correction applied to the Pearson residuals. So here are the steps. We start from a given incremental triangle, X. We fit our Poisson, over dispersed Poisson chain ladder method to this, and we find residuals, Pearson residuals for the upper triangle. We adjust these Pearson residuals by doing this little trick from the previous sheet, and we obtain these bias adjusted Pearson residuals for the upper triangle. We also have the fitted values for the upper triangle. These are the mu heads. We can easily find them by evaluating the exponential, evaluated in alpha head plus beta head, and you just take the appropriate alpha, the appropriate beta for each of the cells in your upper triangle. Yeah, so that's what we get. Do know we only focus here on the upper triangle because residuals can only be constructed for observed values, so only for the upper triangle. We also focus on the fitted values that we obtain with our GLM for the upper triangle. Now what we're going to do is we're going to create artificial triangles. So we're going to create a replicating triangle, an artificial triangle, by using this connection between the residual, the fitted value, and the corresponding incremental amount. So that is the relation that I displayed over here. If I give you the residual, and if you combine that with the fitted value for mu, then you get the corresponding incremental claim amount. So we're going to do this by shuffling around with these residuals. So how are we going to do that? Well, I should read, of course, from step 0 to step 1 and not immediately to step 2. But how are we going to do that? We take all the residuals, we put them in a basket, and we're going to draw with replacement. We're going to sample with replacement from these residuals. So that's where the bootstrap idea is coming in. So I need to pick a residual for each cell in my upper triangle, and I do that by making a draw with replacement from the residuals as I calculated them in step 0. Yeah, so each cell now gets a random residual drawn with replacement. I can do that because I'm assuming that these residuals are independent, that they are identically distributed, so I can easily do that over here. Having these resampled residuals, I combine the residual that I picked for each of the cells in the upper triangle. I can combine that with the fitted value for each cell in the incremental triangle as I calculated it initially, right? And I combine these two guys using the relation that I showed you over here. The only thing that I did is instead of using the original residual for that particular cell, I now replace this residual with a random draw from the basket of residuals that I constructed. Yeah? And I did this little tweak. I don't use the original residuals, I use the bias adjusted residuals. So that's what I get over here. Using the relation on the previous sheet, I now get an incremental triangle, which is different from my original triangle, right? But which is constructed in a solid way, because the only thing where I intervened is by saying, okay, instead of using this particular residual, I now reshuffle and I use a similar but slightly different residual. So I get a new incremental triangle. Of course, if I have a new incremental triangle, I can fit again my chain ladder. And what I mean with the chain ladder here is the GLM version of the chain ladder, right? So I do my GLM, my Poisson or over dispersed Poisson, doesn't matter here because I only care about the structure for the mean, the parameters used in the mean. So I fit my Poisson GLM here and I get my parameters alpha head and beta head for this particular artificial triangle indicated with a star. And if I have my parameter estimates, I get a point estimate for each cell in the future, for each cell in the incremental triangle in the future. So I get my mu stars for the future. But these mu's are an estimate for the mean of the cell in the incremental triangle. What I want to do now is I want to go from the mean to an actual randomly picked observation from the over-dispersed Poisson with this value, the mu star, as the mean. So I make a draw for x star. Well, x star is from an over-dispersed Poisson distribution, which has as the mean the mu star that I have over here, and which uses as the dispersion parameter that I initially estimated for my triangle. So this last step is here to add the so-called process error, to go from a point estimate from the mean to a random draw from the distribution that I assumed originally. So if I do this, I now get a simulated value. I get a value x star for the outstanding reserve. If I sum all of these guys, then I get a value for the outstanding reserve. If I repeat this experiment 10,000 times, then I get a predictive distribution of the outstanding reserves, which takes into account both the parameter estimation error as well as the process error. And from this predictive distribution, I can calculate a value at risk, I can calculate a tail var, I can do whatever kind of, I can calculate whatever or estimate whatever kind of risk measure that I want to obtain. So that's the recipe that we put together, which allows us to go from having an estimate for the outstanding amount plus a mean squared error of prediction. What we do now is we're really capable of generating scenarios for the outstanding reserve, scenarios that take both the parameter estimation error as well as the process error into account, and which rely here then on this over dispersed Poisson setting and the specific parameterization that we went for the linear predictor. So this is also one advantage of bringing in this idea of GLMs, because now you can also rely on this bootstrap kind of thinking, which in this case is using the idea of the residuals and the resampling of the residuals. So it's a parametric bootstrap approach, which relies on the residuals that we identified here. So my usual questions are then, at which step do I take into account the parameter estimation error? That's over here, because initially, if you would do this GLM once on your triangle, you get alpha heads and beta heads, and they would be fixed, right? But now by repetitively doing this GLM estimation, you'll get 10,000 alpha heads, you'll get 10,000 beta heads. So you get a grip on how uncertain the estimation of these parameters, how that goes. So besides keeping track of the 10,000 values of your reserve estimates, you could also keep track of the 10,000 values that you obtain for your alpha heads and your beta heads, and that allows you to get a grip on the parameter estimation error. Where do we bring in the process error? That is over here. This is the point where we really rely on the variance assumption, on the distributional assumption that we made for our triangle. This is the point where we really say, okay, you're over dispersed Poisson, so I'm going to generate a value from the over dispersed Poisson distribution with as mean the mean that I calculated so far based on my alpha head beta head star, and with as the dispersion parameter that I initially estimated at the beginning of the whole process. I see that I got a question in the chat from Marco. So Marco says, could you make an example of how a particular cell in step 1 is computed? So if you look at step 1, that's the resampling, right? So what I need to do here is I calculate the residual. What I need to do here is I calculate the residual for each cell in the upper triangle. So if I would have like 10 rows and 10 columns, that would mean I've got 55 cells in the upper triangle. I've got 55 residuals calculated. I put these 55 residuals in a box or in a basket, and I'm gonna pick at random with replacement one residual for each cell in the upper triangle. That's how I fill this triangle in step 1. I just resample from the residuals, and then I combine this black triangle here with the triangle that I initially estimated for my upper triangle with the mu heads. So the mu heads, they don't shuffle around, they really stick to their own cell. But having then these two ingredients, I can get my artificial incremental triangle, my X star, by implementing the relation that I have over here, which I will do then for each cell I and j in my upper triangle. Does that help, Marco, or yes? And then a question from Cedric is, could you repeat how the process error is included in step 5? Yeah, I must say that's the step that students usually struggle with. Or that must be the step where my explanation usually fails. But if you would end in step 4, then you only made an estimate for the mean of the cell. You've got an estimate, you've got a value for mu star for each cell in the future, right? And if you repeat the process, you can do that 10,000 times, etc. But you only have an estimate for the mean value, for the best estimate. And that's okay if you're interested in that. But if you want to say, I want to go from this estimate for the mean, I want to step from there to a value that I draw from a distribution with this mu star as the mean. Then in the last step, you need to make a draw from an over-dispersed Poisson. Yeah, and that's the point where we bring in the process error, where we say, okay, besides the parameter estimation error, which we introduced in step 3 and in step 4, we're now going to step from just looking at parameter estimation error, we're going to step to also taking into account the variability in the distribution that we assumed underneath this triangle. And that was the over-dispersed Poisson. So what we're going to do here is we're going to generate from an over-dispersed Poisson with as the mean this mu star for each cell that we obtained over here. And now you can ask, how would you do this? But how can we do this? We have the recipe over here, in fact. We've got the explanation for the over-dispersed Poisson, we've got that here. So if you want to make a draw from X following an over-dispersed Poisson, then you need to have an estimate for the phi hat, we have that. And you need to make a draw for Z, where Z is coming from a regular Poisson distribution with as the mean mu divided by phi. And this is something you can do with R Poisson with a random generator from a regular Poisson. So you generate a value for Z, you multiply it with phi, and that would give you the draw from this over-dispersed Poisson distribution. That's how you would do it. And the reason to do it is to make the step from a value for the mean to a random draw from the distribution that we assumed initially, and where the mean is now obtained, where the mean has been obtained in the previous step, and where we say, okay, we want to go from mu star really to X star. That's the step we're going to take here. So this is important. This is mu star, but here we have X star, and X star has mean mu star, but we make a draw here from the whole distribution that we assumed for this incremental triangle. So having the bootstrap, yeah, I removed the pictures, in fact, from my sheets, but you would get then a nice distribution based on 10,000 draws along this recipe. So you get the distribution of the outstanding reserve, for instance. You can calculate the risk measure from there. You can work with that as well. Yeah. So that's what we did. Today we talked about the basic principles, the necessity to say something about claims reserving. And then we covered a couple of approaches. We discussed the purely deterministic method, the chain ladder. We went to stochastic methods. So we did Mack as a step in between. Then we went to the GLMs. Then we went to the bootstrap. We talked a bit about the difference between parameter estimation and process error. That has to do with the bias versus the variance trade-off that we already discussed in machine learning. And ultimately, we discussed our bootstrap setup to arrive at a predictive distribution for the outstanding claims reserve. Yeah.